Hello and welcome. I'm Brian Caplen, editor of The Banker. I'm here with Ralph Hammers, the CEO of ING. We're in New York. Ralph, welcome. Tell me about this ambitious digital transformation program you've got with 800 million being invested by 2021.
Yeah, well, we started already investing in digital 4 or 5 years ago when we saw the trends coming from Silicon Valley. We saw new business models coming up. We saw the customer behavioral changes as well and the expectations of our customers more and more to do banking on the go. And we were known for being the internet of banks, right? And we basically built a bank around the internet rather than internet around our bank. And through that we created a new business model. Over the last couple of years we've been building a digital bank, moving away from the desktop to a mobile because people have less and less time to spend.
And already I think it's the case that more people use the bank through the mobile channel than any other channel.
Exactly,
right?
So the mobile channel has overtaken the desktop channel, at least in most of the countries in which we work. So you see the trend going in that direction very quickly. That's one trend. The other trend is, as I said, people do their banking on the go. Everybody waiting for the bus or the train. They are not talking to each other, but they're in their social media. That's where they post their blogs. That's where they have their conversations. That's where they put their pictures. That's where they live their lives. And the question is, as a bank, how do you get in there? How do you get into that life? Because that's where they spend their stuff. And for a bank to be relevant, you have to get in there. And you have to be connected to those ecosystems or be an ecosystem of yourself. And that's on the back of creating that one platform that all these tech companies have, because they have one platform across the globe.
Right.
Whereas banks have platforms per country.
Yeah.
How do you
so
create that?
your idea is to have what you're calling an omnichannel, which would be basically one platform for every geography eventually, is that right?
Exactly. If you look at where the tech companies are and how they roll out their businesses, they have one platform and they have one way to interact with their customers. I have, in the 13 countries in which I'm a domestic bank, I have 13 different apps doing exactly the same. Facebook is the same everywhere. Uber is the same everywhere. Why couldn't be ING the same everywhere?
And how long will it take you to get to that stage then?
It'll take quite some time for two reasons. First, even as we are a young internet-based bank, we have some technology that we have to renew. We have many customers that we have to take along as well. So we're not starting from scratch. We have 36 million customers who we have to take along on this journey. So we have basically determined for ourselves as some kind of an intermediate phase, which will be in 4 years' time. We want to have accomplished two things of merging platforms. One big project between two branch banks, omnichannel banks, if you may, in Belgium and the Netherlands. So we're creating one platform for 11 million customers there. And then the project that we call the Model Bank, which will be one platform and one way to interact for all of our clients in France, Italy, Austria, the Czech Republic and Spain.
Right, okay. And you've said that for a bank, if you don't disrupt yourselves, somebody else will come along and do it for you. So how do you actually put that into practice?
The way we put it into practice is that we launch services that we know we will lose income on. For example, we launched Payconic in Belgium, which is a payments app. That payments app takes out the use of and the need for a card system to guarantee the payments going from a consumer to a merchant. So we're totally taking out the card scheme. So we're disrupting the card business here, but we're also disrupting our own fee income from that card business. Let's face it. But I'm convinced that if we don't do it, somebody else will do it.
So, but you must get some resistance internally, don't you? I mean, doesn't the accountant say, well, hang on a minute, what about this income stream?
Yeah, on one side we do. But on the other side, the way we've changed our culture in ING is that people are so aware of this, and that if you are the first one to move, if you are the first one to disrupt, then yes, you will lose some income on one side, but you will be able to compensate by growth on the other side. And that's what we see. That's what we see when we introduce internet banking in some of the countries in which we were already a bank. And we were very aggressively pricing our savings. We were disrupting our own business, but we grew much faster because we took clients from the competitors as well. So that's the way you can actually make it work. So, and that's what keeps people motivated.
So now tell us a little bit more about this marketplace idea where people go, it's not just banking, it's other kinds of shopping they can do, and presumably there's a data element to this, so using customer data to figure out what other kinds of services they would like to have.
Yeah, so in the future, in order to be effective in these social worlds, in these social ecosystems, there's only two things you can do as a bank, in my view. One is to create an ecosystem of yourself, the go-to place for financial services. And that go-to place should be having a real strong identifiable brand. And should be known for its openness, because all these ecosystems that are so successful are open. So we should be open to deliver also third-party products on that ecosystem. And these third-party products can be banking products from our competitors even, but it can also be other products. It's okay. It's okay as long as people find it sufficiently important and attractive to come to that ecosystem.
But now there's a challenge for banks, isn't there, in using the data, and I think you've had some issues with this in the Netherlands. Even in an anonymized form, there's big sort of privacy issues around data. So how do you overcome that?
Yeah, so you have to be really careful, honestly. And we do have a responsibility as banks to maintain the trust and the trusted relationship that we have with our customer. So yeah, you'll have to balance, privacy, data privacy, and what a client wants. And you should really give the client the control over their data. So if they don't want that data to be used for opportunities in order to improve their financial planning, we shouldn't use it. If they do, they should basically give permission, and we can use it. And they can switch it off any moment in time when they like or don't like this service. So that's the way to go about it. Give it back to your client. I call this, the democratizing bank, and that's what we need to do. So first, it is the bank, is the client who is in the driver's seat, who is fully empowered, and secondly, you should be open to third-party products and third parties to offer products to your own clients. That's the only way to do it, fully open.
And what about the use of social media? I mean, I think you have discussed using social media as a way of credit scoring, and you've said you can actually tell whether someone will default on a loan according to what they post on their social media site.
Yeah, so there is many different ways that these algorithms and these self-learning algorithms operate, and basically you use the old-fashioned way. So you will still have data with credit bureaus and your own data in the bank, but you can also go out and see what data is out there in terms of behavior, in terms of statement, in terms of activities of clients and plans of clients that they communicate about in social media, and you can derive a specific pattern there that helps you scoring these clients. It's how it works. The good thing is that we're all trying these kind of algorithms and seeing whether we can have services that are differentiating to our clients. Because the only reason why we do this is if we can give you an answer to your credit request within 10 minutes, and whether it's yes or no, in 10 minutes, people getting a no are still appreciative of your service. In 10 minutes, people getting a yes, we can actually give you that loan. It's even better, clearly. And within that 10 minutes, getting the money on your account is a perfect experience, right? And that's what we have. But you see that the ones who we even decline rate is very high on
because they got an answer quickly.
Exactly, because people just want to know. And it's consumers that give us that feedback. It's small and medium enterprises that give us that feedback as well. Rather than having this process with your bank that takes about 5 weeks, discussing with credit guys, account managers, and delivering 3-year-old financial information, and then getting a no. Getting your no in 10 minutes is a better service, but it's a no.
Okay, look, we've talked a lot about how the bank faces the customer, but what about how you organise internally? ING's talked a lot about sort of having agile, multitasking teams. So how does that work?
Well, if you want to compete in the world of tech, and if you want to become increasingly want to become a tech company, you have to organize like a tech company. You have to get the culture like a tech company. So
whereas most banks tend to be very hierarchical and
exactly,
silos.
Exactly.
Silos,
so that's what we have switched around. We call that the ING way of working, and we've done this in a couple of countries, and we're now rolling it out. So 2 years ago, we introduced this in the Netherlands, which is basically one of the older parts of ING.
And did you get a lot of resistance to it?
Actually, no, we didn't. And it's remarkable to see how quickly people adapt and how much they like it. So what we've done, the old-fashioned way of structuring is, you have a marketing department, a product development department, you have a process department, IT
and they
department.
don't talk to each other.
And they, the marketing department takes like 3 months to come up with a new idea. The product development department takes 3 months in order to kind of see what kind of product would cater for that need. Then the process department would kind of think about the process to support that whole thing, and then the IT guys will have to program it. What you do is actually you get rid of these departments. You put in place what we call a squad. And you have a marketeer, you have a product manager, you have a process guy and a IT lady, all in the same team. And every 2 weeks, they agree what they will do next in order to improve the service to our customers. And every 2 weeks, you see whether you're making progress or not. And every 2 weeks, you can decide whether you want to fail fast and start to do something new or continue. And that 2 weeks, you can compare to an average project term of 18 months.
Right.
Now, so you're much closer to what's really happening. You're much faster, so much more agile. And honestly, and this is the thing that this brings, you can decide to fail fast, which is something specifically in the bank is not so easy, right? So in the bank, we have the culture of zero tolerance, an area in which you are not allowed to make any mistake. And then you have a bit of a culture where you basically are applauded for making mistakes, because making mistakes in this way gets us further. We learn through these mistakes. So that's a balance you have to find in the bank, where it is different in the bank from any other company, I think, to introduce this kind of culture.
Ralph, thanks very much for talking to us and telling us all about it. Thank you.
You're welcome.